Welcome to Street Talk, S&P Global Market Intelligence podcast that offers listeners a deep dive into issues facing financial institutions and the investment community. I'm Nathan Stovall, and on this episode, we're talking about bank liquidity, the different funding strategies banks are employing, and the outlook for profitability, valuations, and regulation in this sector. And joining me on the show to talk about that whole ball of wax is a veteran and one of the better thinkers in this space, Josh Siegel, Chairman and CEO of StoneCastle Partners, which just celebrated its 20th anniversary. Josh, congrats on the milestone, and thanks for coming on the show.
No, my pleasure, and thanks for setting the bar so high.
Easy to meet. Well, Josh, we're recording this on June 23rd. It's about 3.5 months since the liquidity crunch, as we've been dubbing it, erupted in bank land. Things are stabilizing a little bit, but no doubt deposits have become more precious in that time. We saw outflows last year in 22. They accelerated in Q1. And what I want to start talking about is how banks have really responded to that. And it seems like two ways banks have looked to plug the hole, so to speak, is either through broker funds, and we've gone back to the CD market in a big way. Huge growth there, including with a lot of the deposit specials. About 400 plus banks are running CDs above 4%, and many even higher than that. What do you think about that strategy right now, and basically the idea of just sort of leading with rate in order to mitigate some of those outflows?
Well, it's for sure the easiest thing to do. Is it the best? No. When you're competing on rate, you're by definition chasing hot money. It doesn't mean it won't stay around, but you have to pay for it. Right? So, there were a number of things you threw into that walk-in. One thing to note, for example, I had a chat with some senior folk at Wells Fargo not long ago, and they actually completely turned off their the broker-dealer sweep funding. They turned it off because deposits have come in such quantity, they don't need it. Now, that's not the same across the board, but it's not a level field. It is definitely very institution type, geographic. I mean, I would say the preponderance are more challenged than they were, but there are definitely banks out there that are flooded. And it tends to obviously be larger banks, but not completely. There still are smaller banks that are flush. It just depends on the base. So your question about rate is something that you can do tactically, but it's not a strategy, if that makes sense. In terms of the CDs, the thing I always worry with the industry, and it repeats itself over and over, is you employ the strategy too late. It wasn't more than about 2 years ago, I was at an ABA accounting policy meeting, which I do every year. I join in for one of the days, and we talk about topics. And it was when rates were still extremely low. And I remember asking all of these banks, from Community to some of the largest in the country, why don't you guys just lock in 10-year funding at 80 basis points? Right? Like it's never this cheap. It's just free money. And they literally laughed at me, which I don't care, and said, "You're crazy. Like, we're funding at 5 basis points. Why would we pay 80?" And of course, I was just there a few months ago, and they're like, "Okay, you were right." Like, I wasn't because I was so insightful. If you just look at history and you're at something that's asymmetrically near the bottom, take advantage of it. Fine, you're going to have a short-term reduction of earnings, but a long-term stability, more predictability. And so here we are, rates are probably nearing a peak. Maybe not, but looks like it's nearing a peak. And now they're like, let's term out. Maybe not. It's fascinating, right? It's just, we always kind of get to the answer late. And that could pose a problem going forward.
Well, and to your point, I mean, in Q1 and Q2 of last year, even, after the Fed had started, we hadn't really seen anybody look to grow their CD book. And now, it's everybody flooding it. And you're not even seeing many people going out too far either. It's almost like they're preying on a pivot. If you look at where the 3-year CD curve is versus the 1 year, that's pretty flat right now. And that kind of tells you, I don't know. I mean, you can make, I'm not saying these should necessarily be out there at 5+% on the 3-year or anything like that. But I think your point is well taken. And one of the other things, I happened to look at these numbers yesterday, your point about size, it really is important. Since year end 22, the big guys, those over 250 billion, have actually seen inflows, and the regional banks, the ones who had stress, saw a huge decline, but the three that failed drove 250 billion of those outflows, whereas the smaller guys, have seen sort of more modest numbers. And I would be willing to venture, and I know you talk with banks around the country, you're saying it's uneven from region to region. I bet some of those rural markets continue to be pretty deposit rich and haven't seen the same. Is that a fair statement?
I asked a lot of smaller bank CEOs because I would have figured, IntraFi/Promontory, I would have figured there'd be a boom in reciprocal, right, from business depositors. The general sentiment that I've gotten back from CEOs of smaller banks is a couple of clients asked, but really no, very little. So granted, I hate broad brushes, but generally the smaller community banks are fine. They didn't see outflows. It's obviously more challenging than it was, but it's not a desperate situation. So it is definitely, I think, more tied to regionals. And again, it's not all the regionals, but let's just say, again, with a broad brush, which is dangerous, the regionals, because the regionals for a long time have had this issue of where do I fit in the market? I'm too big to be a community bank and have really strong community ties, and I'm too small to really compete with the SIFIs, right? And so when I would talk to real estate firms, large corporates, they would always have the same commentary. If I want to get the best rate on a loan, I go to the regionals, right? And so they've been competing on price the whole time. And that's in and of itself not a problem. It's how you manage that. And that comes to, I think, a deeper point around your question. You know me, I'm a data guy. I love data. And you can go back as far as government has data, which is pretty much 34. And you can look at ROA. And I've charted this out for folks who sort of said, really? The ROA generally is between 0.8 and 1.1 every year. Doesn't matter when rates were 20% or near zero. Now, in the transitions, it can get a little wonky. But banks are spread lenders. They're not supposed to be interest rate prognosticators. And that's sort of what was going on, is people were playing rates. And I learned my first day at Salomon Brothers a long time ago, you don't bet interest rates. You just don't.
Right.
You hedge it. And they didn't hedge it. And it's not all banks. It's the subset that got into trouble. And this may come to the question of some regulation things that maybe we talk about or don't today. But, the banks have to just sort of remember, this too shall pass. Every rate cycle is bumpy. And if you're trying to overcorrect, like steering a little sailboat, you just sometimes have to hold the till still and let the little wobbles occur, because you're going to get to the same destination. And I think over panicking and overcorrecting, in month to month or quarter to quarter is a dangerous thing to do in a business that has, a multi-100-year history.
Right. And that transitions to a point that we've been talking about, and maybe you think this is overcorrecting too, but I put in the context of, rather than go out there and put a 5% CD, let's just say as an example, 5.5 to plug a hole, should you look at the other side of the balance sheet and go, wait a minute, we're doing that to meet a 7% growth goal. Should we change that to 5? Should we change that to 4, or maybe even be more aggressive? And 4 months ago, most of the banks we talked with said, no, we're still feeling pretty good. Now we're hearing, we've dialed back a little bit, either a combination of preserving liquidity, but also maybe late cycle. We're a little more worried about credit. What do you think about that right now? Do you think that that's an overcorrection to say we're going to change our growth goals, or do you think that that's a sound strategy in the face of maybe what we've seen on funding? And I know you painted it as, I agree with you, it's an earnings issue, not a big balance sheet issue from the funding side for most. But still, even from an earnings perspective, do you think it makes sense to dial back growth goals?
The answer is, again, dependent. And I'll explain with the dependent. And it's not a complicated formula. You don't have to pull out a calculator. If you're in a market, if your bank is in a market growing at 3%, right? And you can get data like that, right? Look at population growth. You have more old people coming in or younger people. Why does it matter? Because young people's incomes go up, older people's are flat, right? So you can get into the data. But if your market is growing at 3% and you have a goal to grow at 9%, how are you doing that? How are you doing that consistently? The only way you can get more loans, originate more loans, and grow faster than your local GDP is to either underprice the loans to steal it away from a competitor or take more questionable credit quality loans that other banks are rejecting. That's it. That's the only way consistently. Yeah, sure, you can steal a relationship here and there, but generally, you can't consistently outgrow your footprint.
I mean, if you're taking risk of some
you're
sort.
You're taking risk.
Yeah.
And that's the same question. For example, I know it's not the question you asked, but it's related. Where was the board at Silicon Valley or Silvergate? And, scratching there, how are we generating these outsized earnings? Like, do you really think you're a genius? No, you were taking a risk that you didn't quantify. You were taking a massive interest rate exposure, right? What you should have done is one could argue you should have taken all those deposits to begin with because you didn't have the loans. And the whole point is you're a lender, right? And you're rehypothecating deposits. But your goal wasn't to borrow overnight deposits and buy long dated government securities, right? It should have been to put it overnight somewhere, right? And yeah, you're not going to make a lot. That's the point. Because you should be generating about a 10 to 12 ROE. That's what a stable bank looks like. And you can print that rate of return from now till kingdom come. But if you try to make it 20, it's going to bite you, right? And so it's the same thing here to your question about growth. You have to look at your market. If I'm in Nashville, which is booming, yeah, then I can even up my growth rate because there's more being done. I should be getting a bigger piece. But if my market has a certain growth path or shrinking, right? If I'm in a part of the country where I'm losing population, the market is shrinking, to say, well, I think we have to target a 7% growth rate. Really? I mean, just stop and think. These aren't complicated things. So, if we just take the broad brush of generally the economy, no, you should be dialing back your expectations because you are the market. You as the banking industry are the economy. But you can't escape that.
The old line, you're a thermometer of your local economy. And so, yeah, on a national level, right, where we are for sure. But to your point, I'm sitting here in Charlotte, North Carolina. Things are still moving pretty darn good here. But if you're in a slower growth market, particularly if you're in a slower growth market that is also facing some of the funding pressures we're talking about, then yeah, it's kind of staring you in the face of what you should be doing. It is, I think, what you're saying.
It is, and I think again, I like using these two words because it's the way I've always seen the industry. The best performers do it is think strategically and tactically. So the first thing we just talked about is the strategy, right? You really over a cycle can't outgrow your market. But then there are tactical moments, right? Hey, maybe at the golf club you heard that the CEO of the bank across the street, they're nervous and going to pull back. Well, that might be an opportunity for you to lean in and take some business that is creditworthy. But they're just being gun shy right now. And you're like, wait a second, even in a bad market, there's still good loans. I'm going to lean in. I mean, a great example of that years ago, I thought was Frank Sorrentino at Connect One. Around 08, there was $1 billion bank and everybody froze. And he's like, well, not every loan is bad. And he leaned into the market wisely and the bank grew tenfold and really hasn't had any credit issues. So genius move there. That's a tactical move, though, right? He saw that despite the backdrop, that he could use that moment of fear. What is the old adage, right? When there's blood in the street, buy real estate.
Yes. Well, we heard Aaron Graff at Triumph say at a recent conference, everybody's freaked out about office. I'm not. I haven't made a CRE loan in a couple of years. We're leaning into office now because the prices look pretty good from what we're underwriting against.
Right. And it comes back to the original point we just talked about is the CD thing. The general tone of the industry is I come to the right decision too late. Right. And that's sort of, I think that the comment that you just brought up is the right point is, okay, yes, I think that large office CRE is in for a doozy this year, but that doesn't mean there isn't good opportunity. So if you can figure out how to structure that or how to get into that opportunity, just be wise about it, right? Don't load up, just be tactical. You can actually do very well. So this is going to be the moment for, I wouldn't say as far as out of the box thinking management teams, but definitely slightly outside the box, right? More creative thinkers. They will be the new fantastic banks after this cycle comes and goes.
One of the things we haven't seen in the investment community, and maybe this is an unfair way to put it, but is a lot of creativity in terms of assigning price. Sure, there's some underperformers, but we've heard regularly people on the sell side and buy side argue that the group's been painted with a broad negative brush and valuations have gotten creamed. You've looked at the space a long time, talked about where earnings sort of come back to and tend to take a longer view. What's your view of valuations right now? Do you think it's oversold? And we don't have a lot of comps in the private market with M&A trades because there's almost nothing going on there right now too. But how do you feel about it right now?
You're going to hate my answer. It depends. It always depends. And again, I hate broad brushes, but if you're asking for my broad brush, I think things are generally cheap. I think it's oversold. I think that the average investor doesn't really understand the difference between a good bank and a bad bank. And there's this old adage, probably too long for our podcast, but the short version of this old adage is this kid wants to be a jeweler, and he goes to a jeweler when he's young and says, I want to be the apprentice, and jeweler gives him a stone, hold it, touch it, taste it. He does this day after day after day. And then finally, after months, the kid is like, I came here, you said I can be an apprentice. All you do is have me look at rocks all day. It's like, jeweler gives him one more. He said, look at this stone. He's like, I don't want to. He said, look at it. He said, look at this diamond. He goes, kid looks at it and says, it's not a diamond. He goes, aha. Right? We call it, holding the diamonds. When you're around it long enough, you tend to see the patterns of good strategy and management and bad. And so I think there is a subset of the investment community that really has specialized in the space and can find the value. And there's a lot of value. A lot of oversold platforms because people can't tell the difference. Like, aren't they all SPPs? No, I can quantify it for you. There were 204. I didn't make that up. There's 204 banks that basically had huge securities books compared to their loan books in varying degrees. And we've looked at it. Again, this isn't magic, Nathan. This is just data. And the great part is this industry is perfectly standardized. There's lots of data, and you can tell the banks that played this bond trade, call them bond banks. But that leaves 4,000 and change others that didn't.
Well, and they tend to buy the same stuff, to your point too. So it's not too hard to look at, and we've got repricing and maturity disclosure, so we can look with a pretty good idea about how far out the curve they went, not only with the size of that portfolio.
13 years on average.
Wow, for those 204.
Yeah.
And so best case, they've got a duration trap, call it.
Yeah.
And worst case, maybe more.
It is, but keep in mind, if a bank is growing, let's say at a modest pace of, pick a rate, 5% per year, 10 years compounded, this problem becomes a much smaller piece of their balance sheet, right? So even, I hate the phrase growing out of it, but just naturally you can to some extent grow out of this problem, even those guys. So if you can retain your deposit customers, and it's definitely worth paying a little more for those deposits tactically in the short term, but long term, you have to find value add. You have to do things that make the customers not want to leave. Maybe it's giving free payroll service, or maybe it's here's free SaaS accounting packages, or we're giving you a discount. We arrange for healthcare benefits for your employee. Whatever it is, find some value add, right? Put some kind of a cash management bill pay solution up. There's so many ways you can find technology or process that make it so sticky that the customers don't leave. Because finding an extra 50 basis points isn't worth upending all my payroll, upending all my accounting, upending all of my bill pay. It's just not worth it. I'll just stay.
Well, and if you look at the banks with the lowest deposit betas this cycle, last cycle, including those with commercial customers, they do exactly what you just said. And I say commercial customers because they've had higher betas, they have more leverage, makes sense versus the consumer. But to your point, we've seen them still maintain pretty low betas because they've got 5 or 6 products in with those customers.
Yeah, do you remember that movie Groundhog Day? I love that movie, right? And there's the line, and he's like, I don't know if God's omnipotent. Maybe he's just been around a long time, right? It's like you and I, we've been around a long time. You can see what works and what doesn't. It isn't high math or great intuition. It's cycles of just understanding the psychology of customers and understanding that you'll have periods of increased earnings and periods of decrease, and you can't fight the decrease. You have to go slow when things are slow.
Mm-hmm. One of the things that we've talked about, you talked about underwater portfolios and the idea of repositioning, selling securities at a loss, paying down borrowings, or maybe even reinvesting at higher yields. But one of the things we've heard people talk about is you kind of have to have the capital on hand. Mm-hmm. You can't really go to market and raise capital. What's your view of capital raising activity? You've supported a lot of capital raising activity over time. Not to say that the industry's capital starved, but it's not where it was a couple of years ago, in part because of those marks on bond portfolios, and regulators seem like they might even want a little bit more. What's your outlook for that for good institutions, let's say? Let's not do the broad brush here, but for not those 204, but for community banks in a good position. When do you think the gates open again?
Well, I can't say when the gate's going to open. That's market dependent, right? So what you control, you can manage what you can manage. I've always been of the view that when I really look at the capital of any bank, I take the sum of their capital and their loan loss reserves, because that's just capital in a different accounting, sector. And so if you really look at the total capital, including loan loss reserves, which are at cyclical highs, right? CECL is maybe part of that, but they're just generally quite inflated. And the losses so far, knock on wood, really haven't been there. So they have a fair amount, as broadly, a lot of loss absorption capability. And that is what banks are built to do. I mean, the average charge-off is about 1% historically, right, for the last 30, 40 years. That's about where it should be per annum. Now, there are periods where it gets to 2, 3, 4, 5, right? But again, if you're a bank making even an 8 ROE, right, you can absorb losses and still keep adding to that. Your shareholders may not love, the net return for any given quarter or year, but you're not out of business. And so it is a difficult time, tying in your last question about, should I be investing now or should I be waiting? I don't know. Banking is generally something that you invest in over a long cycle, right? Airlines, something you do in and out and find moments, because if you hold airlines a long time, you tend to lose money. Banks, you make money over incredibly long cycles, and the data is just there to prove it. So for these banks, this is obviously not the moment to raise capital unless you need to. If you need to, then you need to. Like, that's it. Sorry, you're going to suffer dilution. But broadly, I don't think that there's going to be much need in the short run. I think there will be an increase in loan losses. I don't think it'll be catastrophic. I mean, this is me just distilling a lot of data. I think people forget that commercial real estate is not a category. There's multiple categories. You have non-owner occupied, right, which is the value of a square foot of rentable space as often as it's reset. A hotel is the most extreme, right? It reprices daily, right? So the value of real estate on non-owner occupied directly affects the probability of default. Owner occupied, which community banks do a much greater percentage of, is just a business loan further secured by real estate, right? A factory, the diner where the food's made. As long as people keep eating at the diner, the probability of default doesn't change. Who cares what the value of the diner went from 500,000 to 300,000? Doesn't matter. If it defaults, yes, you'll have a higher expected loss, but the probability doesn't change. It's going to, I think, hit the regionals. It's going to hit the money centers, although they're printing so much money, it doesn't much matter. That's where. And again, like you said, Charlotte, Nashville, pick your markets. Any problem with commercial real estate there? No, because the city's lost this business, and it's gone to the secondary and tertiary markets, and a lot of them are booming. So it isn't, again, the whole brush. It's going to be very topical and very specific to the markets and the type. So community banks tend to have a much greater percentage of owner-occupied commercial real estate. Regionals and money centers tend to have much greater percentage of non-owner-occupied. So again, it's all in the data. It can all be looked at. So no, I don't think that this is going to be any kind of a repeat of 08. I think this is the normal credit cycle that banks are meant to absorb. Earnings will probably be, punished for the next 6, 12, 18 months. And then it goes back to the cycle that we saw, it just keeps going. That's how it goes. It's like saying, oh, the water's coming in on the tide. I wonder if it's going to go out. No one would ever say that, right? Why? Because well, look at the data. This is how banking has been for 100 years. This is the cycle. It will do this.
And that'll create opportunities too, not only from the investment side, but for the good guys who might be able to look to another market. In closing, one of the things that we've touched on at a very brief level, but I mentioned at the opening, regulation. And I know you've spent time working with banks on preparing for regulatory changes, and you talk with regulators. a lot over the years. We've heard talk about new regulations coming down the pike. Almost all of those focused, though, on large regionals and up. Have you got any sense that any of that could trickle down or that we'll see anything new for community banks? And the one place that I feel like I could hear some more focuses around sort of deposit composition, industry concentration, uninsured deposit concentration, things like that. That's about all that we really heard. What's your sense?
Further echoed yesterday by Powell that they're focusing 100 billion and up. I don't see really any significant or maybe even any new regulation for smaller community banks. They finally enjoy support from both the Republican caucus and the Democratic caucus, both for reasons, right? Republican tends to support it because they want less regulation, more rural markets, right? Tend to be red states. Then you look at the Democratic side, community banks are the largest lender to small business. They are the ones that support, inner city markets. So they support more of the poor generally, right? If you just sort of look at the wealth distribution curve. And so up and down the halls of Congress, I really only hear support for community banks. There's nothing partisan in there. And the Fed now is being pretty clear vocally that the community banks really aren't the focus here. The items you brought up, the regs are already on the books. The guidance from FDIC was published a long time ago on the proper diversification for your deposit book, right? By depositor, deposit type, deposit duration. Like that's already there. The problem was the enforcement, which I'll give Powell credit. I wasn't as big a fan of Powell in the past, but I'd say he's done a reasonably good job of being more honest and transparent. When he said we failed with the Fed, right? We failed on supervision. And yes, you did, right? It happens. I mean, banks fail. These were pretty spectacular. I mean, yet life goes on. But this was forgetting the cardinal rule from the S&L crisis about duration and interest rate exposure. I mean, this is just repeating the old problem. And again, it isn't all the banks. It was 204 of them. But so I think while the initial reaction was, we have to revisit regulation, I think as people actually have revisited and are reading, they're like, oh, yeah, we already have that rule. Like, yeah, it just wasn't enforced. So just start enforcing. So that's what I'm hearing more and more is less about adding regulation. In fact, I don't know if you were watching the testimony, but there was a lot of questions from both parties saying, I don't want to affect community banks. I don't want to, do anything that's going to slow their lending. We need the lending in the markets. And that was kind of across the board. And Powell kept saying, really not focusing on community banks. Our leaning is to the large ones.
Well, and you saw it with the special assessment too, right?
Yes.
And I thought that was a different level of nuance than we've seen historically. So, I mean, I think that totally jives with what you just said. Well, I think that's a great place for us to leave it. Remember, everybody, this too shall pass. These things are long-term cycles. There are a few problem childs out there, but that is not the industry. Let's not repeat with a broad brush and think longer term and move on. Josh, thank you so much for all those thoughts. Great to be with you again.
Likewise.